Hello and welcome back to Money Illuminated, the podcast where we talk about investing, planning, and helping you make confident decisions with your money, one episode at a time. In the last episode, we talked about preparing for retirement, the money, and the mindset that comes with it. Today, we're going to get a little bit more specific with what are your actual options regarding your pension schemes. With me, as always, Mr. Jack Saunders. Welcome, Jack. Thank you very much for joining me again.
Hello, how are you?
I'm very well. Thank you very much. How are you?
Yeah, I am all good. Looking forward to the fact that it's nearly the weekend. We're recording on a Friday, so we're nearly there, but I don't think we'll be playing golf this weekend looking at the clouds in the sky.
No, there is a huge football game from my side, though. As a Portsmouth fan, we are hosting Southampton, so I'm going to avoid being anywhere near the ground for a few hours, but I am very excited to watch it.
The good thing is I don't think you'll get many people listening and not wanting to work with you by saying that that's the type of football game that you like. I think if I said who I've supported, there's risk that people won't work with me in the future. So we'll keep that a secret, I think.
That's true. And I'm on the better side of the derby, I'd say. So,
yeah, sure. If you say so.
Brilliant. Well, we're doing a slightly shorter episode today because we just want to dive into kind of the key parts to all of this. But pensions are a real minefield. I think everyone can agree with that, especially if you're not in the industry. It's, didn't even know my pension was invested. I didn't know I had multiple options. So hopefully we can kind of break each type of pension down in a little bit more detail for everyone, and just kind of lay out the options so that they're nice and clear and people can kind of make those informed decisions moving forward. But what pension should we start with, Jack? Would you like to start with kind of defined benefit pensions, as the options are slightly more limited there, but obviously they're fantastic pension schemes?
Yeah, let's do it. I mean, final salary, defined benefit, career average schemes, they all kind of are different iterations of the same principle of what that pension scheme is. And unfortunately, unless you work in the public sector for the NHS or local governments and so on, you don't really tend to get them anymore. And the reason is they're just too good to be true. I mean, I would love to have one. And believe it or not, there's some people out there that genuinely want to give them up for no good reason. We've spoken to many of those in our time, and it's difficult because, you're giving up a really good pension for a sizable chunk of money, but ultimately the really good pension in the first place often outweighs what other options you can have. So I guess in summary, a defined benefit final salary pension is a secure source of income that you receive from your retirement date, typically 65. You can take it earlier than that, from 55 or 57 onwards. You can take it later than that as well, and you'll either be sort of penalised or rewarded if you take it at a different point to the normal age, as much as I don't really like that term for it. And it's as secure as a pension can be. It's not 100% guaranteed. There are circumstances where people's benefits are reduced or moved to a different environment, and you won't get 100%, you might get 90% or something along those lines. But the fundamental is it's typically a secure income paid throughout your lifetime, typically paid monthly, typically goes up with inflation to some degree. Occasionally they may have a cap of 3, 5, 10% a year. Sometimes it will have a fixed amount of increase, 3 or 5%. Sometimes you have benefits which are called GMP, guaranteed minimum pension, where it doesn't increase at all in retirement. So it's not all straightforward, but broadly speaking, it's inflation linked. Typically, you have a spouse's pension attached to it. So if you've got a wife or a husband and you pass away before them, they tend to receive some sort of income for the rest of their lifetime. If there's a huge age difference between the two of you, it might not be quite at the maximum level they're entitled to, and that is typically 50% of the income that you were receiving as a member. But yeah, there's normally some sort of death benefit for a spouse. Occasionally you can get them if you're not married. Sometimes there are rules where the scheme can say, yeah, we will still pay out if you're long-term partners, but we won't go into too much on those levels of details because it's always scheme specific. And then I guess the other one is tax-free cash. It's one of the reasons people think about pensions and retirement the most, is that they imagine this big tax-free lump sum that they receive. Not all final salary or defined benefit pensions offer a tax-free lump sum. Some of them do, most of them do. but there are the odd scheme which doesn't. But typically, you commute, you give up some of the annual income you'll be entitled to for a tax-free lump sum. Essentially, let's take an example. Your pension might be £10,000 a year, or you might get £8,000 a year, and in return for giving up the £2,000 a year difference, you might then get a £30,000 tax-free payment when you retire. Unfortunately, that's not every year. It's a one-off thing. And those pensions are very much, if you don't take it, you can't come back for it in the future. So typically people take it, but it doesn't necessarily mean it's always the right thing to do. You've got to look at the kind of numbers behind it and what you want it to do in terms of supporting your longer term future. But I guess that's a whistle-stop tour of final salary pensions.
Yeah, very well put. Nice and clear. They're absolutely brilliant. So yeah, like you said at the start, very few reasons to give it up, but we'll move on from there. So we then move on to workplace pensions, also known as SIPs, defined contribution plans, money purchase schemes. They have multiple different names, but 90% of people in the private sector will have these types of pensions now, where essentially you'll give up part of your salary. It could be via salary sacrifice. It could just be that you're contributing monthly from your income into a provider pension, and your employer will, in theory, also contribute into that pension. So the minimum in the UK is the employer puts 3% in, the employee puts 5% in. So as long as there's 8% going in between you and the employer, that's the kind of bare minimum that we see in the UK at the moment. And essentially, you are just building up this savings pot. You get tax relief on any contributions you make. If it's via salary sacrifice, you get national insurance tax relief as well. So that's the most tax efficient way to contribute into a workplace pension. And essentially, you just build up this savings pot. And when you are 55 or 57, you can start accessing that pot for retirement. And there's kind of 3 different options that you have at the moment with those workplace pensions. The first one is very, very straightforward. It is classed as your cash out option. So this is exactly what it says on the tin. You essentially cash the whole pension into your bank account at one single point of time. Only 25% of workplace pensions are tax-free. So if you imagine taxing or taking the rest of the pension scheme all within one tax year, you are going to pay an eye-watering amount of tax bill. And we usually show a graphic with this to the people that we're speaking to, and they're like, oh my goodness, why on earth would I do that? Well, there's a couple of reasons why some people would do it. You might be desperate for the money. Something might be up with your health and you want to spend that money early on. It's there for almost emergency purposes rather than to facilitate any kind of income in retirement. Moving on from there, we have annuities. So a lot of people would think this is the only option that they had with workplace pensions because back in the day, it kind of was the only option that you could have. So what an annuity is you get to your retirement age, a bit like the final salary scheme, you have the option to take tax-free cash up front or not at all. The simple way to calculate it is you can take up to 25% of the fund value as tax-free. If you decide not to take any, or you take part of it tax-free, you then give the rest over to an insurance company in exchange for a guaranteed income for life. So very similar to a final salary scheme in that aspect. They probably wouldn't pay as much as a final salary scheme would. However, they are there to provide you with security and an income for the rest of your lifetime. That is automatic. It doesn't need to be managed. The good things with an annuity is you can tailor it to your specific circumstances. So if you wanted to add a spouse's pension, you could add 50%, you could add 67%, you could add 100% if you wanted to, where essentially if you passed away, your spouse would receive that percentage of the income for the rest of their lifetime. So you can add a bit of security there in the background. You can do the same with inflation. So you can add indexation in the background. You could say, I want the pension income to grow by 3% every year, or I want it to completely grow in line with inflation and RPI. However, the more you add to the policy, as we know with insurance companies, they're then going to take more away in terms of the annual income. They're trying to benefit to some extent by signing you up to this policy. And the biggest risk of it is it's very rigid. Once you agree the terms, that's it. It's set in place. You can't take any more. You can't get any less from the pension scheme. And if you passed away and you say didn't have any death benefits attached, that's it. The policy's done. The insurance company gets the rest of the money and nothing else is paid out. So there are a lot of restrictions when it comes to annuities. They are still right for some people. However, they've become a lot less popular over the last decade or so. And that kind of leads us on to the third option. Jack, if you want to describe what flexible drawdown is for everyone.
Give me the hard one, yeah?
The difficult one, yeah.
So yeah, annuities used to be the only option, and then drawdown was 2015, I think, which is, I think it's the year before I joined the industry. I know it doesn't look like I've been in the industry for that long, but I have. The drawdown became an option, and essentially it's the most flexible way you can utilize this pot that you've created when you retire. It doesn't have to be when you retire. You can access it before you officially stop working, from probably 57 onwards for most people. It's 55 until a couple of years' time. But essentially, the pot of money remains invested. And that's why we've already done episodes on this. It's so important that the investment strategy is something that you're comfortable with, comfortable sticking to through the good and the bad. But you can basically take out as much money as you want, as and when you want to. A lot of people think that you take the tax-free lump sum as one big chunk, 25%, and then you just take a taxable withdrawal, and people think that you might take that yearly. So once a year or twice a year or however often, you take some money out, you pay yourself, you live off of that on top of any other income or assets that you may have. You can chop and change the withdrawals whenever you want to, and a really good benefit, unlike annuity, where if you say, Elliot, I'm going to assume you and I are married for a second here, right? If I die first, but I've said you get half of the pension, you get half of the pension when I die for every year until you then die. But if I do that and you pass away before I do, I can't then reallocate that 50% to somebody else. It's gone. It's a lost benefit, and I've paid the cost of that by having a lower income. With drawdown, that doesn't happen. You can name pretty much anybody you want to receive your pot of money whenever you die. It doesn't have to be one person. It could be a number of different people. It could be trusts and charities and things as well. So that's really good. There are some tax rules around what happens if you die before 75. There's no income tax to pay if you designate it within 2 years. If you die after 75, it's income taxable on whoever is receiving that money as and when they receive it. So there's lots of nitty-gritty bits of detail that we need to think about. But essentially, it's a pot of money that you can use however you want to, really. The trap of people thinking that you have to take the 25% all in one go, well, if you have a fully flexible drawdown pension, that's not the case. You can take it all in one go, but you can take it in installments as and when you need to. That might be you take it as 5% a year for 5 years and you've used it all up. It might be that you just put that as part of your regular monthly withdrawal that you take to pay yourself an income when you retire. So if you were paying yourself £2,000 a month from the pot, well, a quarter of that number could be from the tax-free cash. Half of it could be from the tax-free cash. There are so many ways you can utilize it. And again, having a really good financial plan helps you look at, well, what's the most efficient way to utilize these assets towards the goals that I have. And the investment piece, again, it's so important to get it right. Tax-free cash, the 25%, you've got that available to you forever. But if you die after 75, the pot's income taxable, subject to income tax on your beneficiaries. So planning around when you want to have used up all of your 25% tax-free is another important part. And one of the huge benefits of these pensions is being removed. And that is that since I've been in the industry, actually, these pensions were not subject to inheritance tax. The government have changed that as of, it's next year now, isn't it? Crikey, it's coming around. As of next April, pensions, defined contribution schemes, drawdown schemes, etc., will form part of your estate for inheritance tax purposes. That will push, I don't even want to think about how many families into paying inheritance tax when they wouldn't have beforehand. So again, it's another important planning point that you need to think about. But drawdown is the most popular. I don't know the exact stats, but I know that a year or so ago we saw some stats saying that it's over 90% of retirees now opt for that. Annuities have become slightly better in recent years, so whether that number's still as high as 90% for drawdown, who knows? But again, annuities haven't gone from being terrible to amazing. They've gone from being not as good as they were 20 years ago and now better than they were 3 or 4 years ago. But the flexibility you have with Drawdown is why most people end up going for it. Doesn't mean it's the right thing for everybody. Of course, everybody needs to look at their own situation. But as a whistle-stop tour, Drawdown tends to be the most popular. And then I guess the other scheme that most people have is the state pension to come on top of it. It's a relatively straightforward one. It's about £12,000 a year. You've got to pay in for 35 years to get the full amount. If you don't have the full amount, you'll get slightly less. You can potentially top it up. Lots of options around it. But yeah, those are your pension options, really.
Yeah, they certainly are. Yeah, state pension. There's a government gateway if you want to look into your entitlement, and if you're missing any years, for most people, it tends to be beneficial to make voluntary contributions and top that up to get the full amount. But apart from that, the state pension is relatively straightforward. You can't access it early. It's being pushed back for depending on your age. But yes, that is there to come in hopefully later on in retirement for the majority of people. But that's it. Is there anything else from your side, Jack, for this episode? I think it's nice and straightforward.
Yeah, I think we've covered everything. It's just don't leave the pension planning until the year before you retire. That's what we say to everybody. So many people just ignore it and think that it's going to be okay, and then you get to that point and there's so many things you need to all of a sudden think about. It can often feel quite overwhelming. So looking at this stuff 10, 15 years in advance and starting to plan for that eventuality is probably a good place to start.
Definitely, yeah. These decisions deserve time, planning, and sometimes proper advice. So if you've got any questions, please feel free to send them in. But thank you very much for listening. We'll leave that there for now. This has been Money Illuminated, and we look forward to speaking to you next time.
Thanks, everyone.